Welcome back to Talk Tickers, everybody. I'm your host, and today we're jumping into a rapid-fire deep dive on Pentair Pleek. That's ticker symbol PNR.
Right, the Q4 2025 earnings call.
Exactly. And, you know, our mission here is always the same. We're extracting the 3 or 4 absolute most actionable takeaways for you, the retail investor.
Yeah, strictly the hard data.
Right, hard data. Translating all that dense Wall Street jargon into, actual plain language.
And figuring out what this means for your portfolio.
Yeah. So, I mean, let's set the stage here, because if you imagine running a massive global manufacturing company right now, it's a nightmare scenario on paper.
Oh, absolutely. I mean, the core market is basically frozen solid.
Right. Nobody is buying existing homes. People feel, totally trapped by these high mortgage rates.
Yeah. New housing starts are incredibly sluggish.
Sluggish at best. And consumer credit card debt is just sitting at record highs.
Which means discretionary spending on luxury upgrades.
Like putting a brand new pool in the backyard.
Exactly. That kind of spending has completely fallen off a cliff.
It really has. And on top of that domestic demand freeze, you've got this strong dollar-hammering international sales, and global supply chains are just getting slapped with, what is it, nearly $100 million in global tariffs?
Yeah, it's an incredibly hostile setup.
So logically, if you look at that macroeconomic environment, the stock should be tanking, right? Margins should be collapsing. Management should be in full panic mode.
Right, but that's the paradox here.
Yeah, because instead, Pentair just posted record-breaking profits. I mean, they expanded their profit margins for the 15th consecutive quarter.
Which is staggering.
It is, and they generated nearly $750 million in free cash flow. So we're going to open up the hood on this earnings call and figure out exactly how they're pulling off this financial magic trick.
It really is the ultimate paradox of the industrial landscape right now. You've got a company sitting dead center at this intersection of consumer discretionary spending and essential civic infrastructure.
Right.
And when the macro environment turns hostile, like you said, you'd expect the discretionary side to drag the whole ship down.
Anchor it right to the bottom.
Exactly. But Pentair's results, they just defy that gravity entirely. They're showing this level of operational resilience that forces us to, look way past the top line revenue numbers.
Yeah, we have to look at the physical mechanics. Like, how are they actually running these factory floors?
Right, and how they're managing their supply chains.
Because we aren't just looking at a flash in the pan quarter here. I mean, Pentair is celebrating its 60th anniversary.
A huge milestone.
It is. But for anyone listening who's really focused on long-term wealth compounding, here is the metric you need to pay attention to. They are approaching Dividend King status.
Which is elite territory.
Very elite. That means 50 consecutive years of increasing the dividend payout to shareholders.
Yeah, and let's contextualize what 50 years actually means in the industrial sector.
Oh, please do, because it's wild.
Right. To hit 50 consecutive years of dividend increases, a management team has had to successfully navigate the inflation shocks of the 1970s.
The oil embargoes.
Exactly. The massive interest rate hikes in the 80s, the dot-com bubble, the absolute destruction of the housing market in 2008.
And a global pandemic.
Right, plus all the severe supply chain inflation of the last few years. To not just survive those events, but to systematically increase the cash you hand back to investors through every single one of them.
It's crazy.
It requires this highly defensive, almost paranoid level of capital discipline.
Paranoid capital discipline. I love that phrase. Because when we look at the headline numbers for Q4 and the full year 2025, that discipline is just screaming off the page.
It really is.
So let's lay out the foundation for everyone. In the fourth quarter, total sales grew by 5%.
Solid.
Yeah, solid top line. But their adjusted earnings per share, the EPS, rose 9% to $1.18.
Outpacing sales.
Right. And their return on sales expanded by 90 basis points to 24.7%.
Which is massive for an industrial company.
Massive. And if we zoom out to the entire year, 2025, they delivered a record $4.92 in adjusted EPS.
A 14% jump over the prior year.
Yeah, generating that record $748 million in free cash flow. So the bottom line is growing almost 3 times faster than the top line.
Yeah, that operating leverage is incredible.
It is, but I gotta be honest. Anytime a CEO uses the word adjusted in front of their earnings, my retail investor alarm bells start ringing.
Oh, for sure.
Like, what are they actually adjusting out here? Is this real cash or is this just clever accounting?
No, it's a vital question, because adjusted can absolutely be, a hiding place for really bad management decisions.
Right, sweeping the dirt under the rug.
Exactly. But in Pentair's case, the adjustments primarily relate to the amortization of intangible assets from their recent acquisitions.
Okay, so accounting stuff.
Yeah, and also some restructuring costs tied to facility closures.
Walk us through that.
So amortization's a non-cash accounting charge, right? It's literally just an entry on a spreadsheet depreciating the value of a brand name they bought.
So no actual cash is leaving the bank account today for that.
Exactly. Now, the restructuring costs, those are real cash, but they're considered one-time events.
It's like paying severance packages for closing a redundant factory?
Bingo. So Wall Street prefers to look at the adjusted number because it strips out the noise of those one-off events.
It gives you a clearer view of the day-to-day.
Right, what the actual core operation of selling water pumps and filtration systems is generating in pure profit. And in this case, that underlying cash generation is intensely strong.
Which brings us directly to that return on sales metric, because that seems to be the real engine driving this whole thing.
Yeah, definitely.
I mean, they expanded it by 90 basis points in Q4, and for the full year, it hit 25.2%. That's up 170 basis points.
Which is wild.
So let's build a mental model for this, right? If I'm running a simple lemonade stand, my return on sales is just my operating margin.
Right.
I sell a cup for $1, the lemons cost me 30 cents, the sugar is 10 cents, the paper cup is 5 cents.
So 45 cents tied up in the physical product.
Yep. Then I pay the kid working the stand 10 cents. I'm left with 45 cents of profit on that dollar.
So 45% return on sales.
Exactly. But Pentair is currently operating in an environment where the cost of their lemons, specifically industrial metals like copper and steel plus global freight, is just skyrocketing.
Oh, it's out of control.
And tariffs are adding massive friction. So logically, their margins should be shrinking, not growing.
Right.
So how on earth do you expand your margin for 15 consecutive quarters when your raw materials are getting vastly more expensive?
Well, you essentially have two primary levers to pull in that scenario.
Okay, what's the first one?
The first is aggressive, targeted pricing power. You simply charge $1.50 for the lemonade, assuming the neighborhood is thirsty enough that they won't walk away.
Right. Pass the cost to the consumer.
Exactly. And the second lever is operational efficiency.
So fixing the stand itself.
Yeah. You figure out a way to squeeze 20% more juice out of every single lemon.
Yeah.
And you fire the kid work in the stand and automate the pouring process.
Okay, so doing both at once.
Right. Pentair is aggressively pulling both of those levers. But the efficiency side, that's driven by this massive company-wide philosophy that their CEO, John Stelk, calls the 80-20 transformation.
The 80-20 rule, the Pareto principle.
Yeah.
I mean, we hear this thrown around in productivity seminars all the time, right? The idea that 80% of your results come from 20% of your efforts.
Right, exactly.
But how does a multi-billion-dollar industrial manufacturer physically implement a self-help concept onto a factory floor?
It is incredibly disruptive, honestly, when you apply it mechanically to a massive footprint.
Really? How so?
Well, in the industrial world, the 80-20 principle forces management to confront a very uncomfortable truth.
Which is?
A massive chunk of their product portfolio is actively destroying their profitability.
Wow. Destroying it.
Yeah.
Oh.
Imagine a Pentair factory that produces, say, 100 different variations of a commercial water valve. The 80-20 analysis typically reveals that 20 of those valve types generate 80% of the revenue and almost all of the profit.
So the high volume standardized stuff?
Exactly. The other 80 variations are what management refers to as quad 4 revenue.
Wait, break down quad 4 for me. What does that quadrant actually represent?
Right, so imagine a graph where the horizontal axis is customer volume and the vertical axis is product profitability.
Okay, got it.
Quadrant 1 is your absolute dream scenario. Massive high volume customers buying your most profitable standardized products.
Easy money.
Right. Quadrant 4 is the nightmare.
The nightmare quadrant.
Yeah. Low volume customers buying highly customized, low margin products.
Oh, I see.
These are the clients who call up and say, hey, we need 100 valves, but we need them painted a custom shade of blue with a slightly different thread pitch, and we need them shipped to 3 different obscure locations.
Okay, so they're incredibly high maintenance, low yield clients. But I mean, revenue is revenue, right? A traditional sales team would argue that every dollar through the door helps pay the light bill in the factory.
And that is the exact trap the 80-20 system is designed to destroy.
Really?
Yeah. Revenue is not just revenue. Quad 4 revenue is literally a parasite on the factory floor.
Okay, explain the mechanics of that. Why is it a parasite?
Think about what it takes to fulfill that custom order for the blue valves. The factory line has to physically stop producing the highly profitable standard valves.
Right.
The machines have to be retooled and recalibrated for the new thread pitch. The supply chain team has to go out and source a custom batch of blue paint.
Oh, man.
The warehouse has to create new staging areas for non-standard packaging. The friction and overhead created by that single low-volume order absolutely obliterates the tiny margin it generates.
And it delays the good stuff.
Exactly. Worse, it delays the production of the Quadrant 1 products that actually pay the dividends.
Okay, I see the mechanics now. By servicing the Quad 4 customer, you are actively degrading your ability to serve your best customers.
Precisely.
So the 80-20 transformation is essentially this agonizing process of just walking away from bad revenue.
It's pruning.
You literally have to willingly let your top line sales shrink in order to save the factory floor from all that mechanical friction.
And that requires immense fortitude from the management team.
I bet Wall Street hates shrinking top lines.
Wall Street traditionally punishes companies severely when top line revenue shrinks.
Yeah.
But Pentair spent the last few years systematically pruning that Quad 4 business.
They just cut it loose.
They discontinued thousands of product SKUs. They fired bad customers.
Fired their own customer?
Yes, they simplified their supply chains. And the result is exactly what we're seeing in this Q4 report. Massive, sustained margin expansion.
Because the friction is just gone.
The friction is gone. The factories are humming with standardized high-margin throughput.
And what's wild is that during the earnings call, an analyst actually pressed CEO John Stelk on this exact point.
Yeah, I remember that.
They wanted to know if this pruning process was still, dragging down their top-line growth. And Stelk's response was really fascinating.
What did he say?
He basically stated that the painful amputation phase of 80-20 is over. The headwind of walking away from that bad revenue is behind them.
That's huge.
Yeah. Now, the entire organization is pivoted toward growing the 80s like, focusing their newly streamlined factories entirely on innovating and over-servicing their highest tier customers.
Which is the absolute holy grail of industrial turnarounds.
Right.
Because once you stop wasting engineering and manufacturing hours on those low-value distractions, you can redirect all of that intellectual and physical capital into dominating your core markets.
Dominate the 80s.
Yes. But to truly understand how effectively they're executing this, we can't just look at the consolidated company numbers.
All right, we have to tear the engine apart.
We have to look at the 3 individual business segments because they are experiencing wildly different microeconomic realities right now.
Okay, let's lay out the raw segment data for Q4 so everyone has a map of what we're talking about.
Go for it.
First, the flow segment. Sales were up 9%.
Okay.
Second, the pool segment. Sales were up a massive 11%.
Huge.
And third, the water solutions segment. Sales went the total opposite direction, dropping 10%.
Right. Now, a retail investor just skimming a press release might look at that and assume, okay, the pool business is booming naturally, the flow business is solid, and the water solutions business is in a state of crisis.
Yeah, that's exactly what it looks like on paper.
But the surface numbers are a total illusion.
All right, let's start with the most glaring paradox on this sheet. The pool segment being up 11%.
Yeah, let's dig into that.
Because I need to push back hard on this narrative. We established at the top of the show that the macroeconomic environment for housing and discretionary spending is terrible.
Completely frozen.
Right. Mortgage rates have locked people into their existing homes, so new pool construction is depressed. Inflation has drained consumer savings, so, discretionary retrofits are getting delayed.
Yep. So in a stagnant pool market, an 11% revenue jump for high-end residential pool equipment just defies basic economic gravity. Like, are people just deciding to build pools instead of taking vacations?
No. Consumer behavior hasn't suddenly shifted toward massive capital expenditures in the backyard.
Okay.
In fact, management was explicitly clear on the call. The industry has not seen a residential pool recovery.
Wow. Okay.
Volume is basically flat to down.
Wait, then where is the 11% coming from?
That 11% growth is not a story of millions of new consumers deciding to upgrade their backyards. It is entirely a story of mechanical corporate finance and aggressive pricing leverage.
Ah, okay. Let's isolate the mechanical finance part first. They bought growth, didn't they?
Yes, they did. A significant chunk of that 11% jump is inorganic growth from a recent bolt-on acquisition called Gulfstream.
Gulfstream. Okay, explain the mechanics of a bolt-on acquisition for the listeners and why it kind of skews that growth percentage.
Sure. So Gulfstream is a company that specializes in pool heating technology.
Pentair purchased them late in the year. And when you execute a bolt-on acquisition, you literally bolt their existing revenue stream onto your income statement.
Right, you're just adding their sales to your sales.
Exactly. So when Wall Street compares Pentair's Q4 2025 revenue to Q4 2024 revenue, the 2025 number includes all of Gulfstream sales, while the 2024 number does not.
Because they didn't own them yet.
Right. It creates an immediate artificial spike in the year-over-year growth percentage.
Got it.
It's a smart strategic move to acquire market share in the heating space. But it definitely masks the true organic demand of the legacy business.
Okay, so you strip out the Gulfstream acquisition and the growth rate drops significantly.
It drops, yeah.
But it doesn't drop to zero. The other, arguably much more important factor driving that revenue up is price. They hiked prices aggressively.
They had to, honestly, because they were facing a severe headwind on the cost of goods sold. During the fourth quarter, Pentair experienced an unexpected surge in raw material inflation.
Which material?
Specifically pointing to industrial metals like copper and steel.
Let's go down a quick rabbit hole here because understanding the supply chain is just so crucial.
Oh.
Why are copper and steel suddenly squeezing a water pump manufacturer?
Think about what a pump is. A high-efficiency pool pump is essentially a massive bundle of copper wiring wrapped inside a steel or heavy composite housing driven by complex electronics.
Right.
Copper is the absolute lifeblood of industrial motors and heat exchangers. But copper is currently in a global supply crunch.
Because of EVs.
Yes. The massive push toward electric vehicles, grid modernization, AI data centers, they're all creating this insatiable global demand for conductive metals.
Wow, so AI data centers are competing with pool pumps for copper.
Exactly. And when global demand outstrips mining supply, the spot price of copper spikes. Pentair buys these metals in massive quantities, so when the spot price jumps, their manufacturing costs skyrocket almost immediately.
So back to our lemonade stand analogy, the cost of lemons just doubled. Pentair is faced with a binary choice. They either eat the cost and watch that beautiful 25% operating margin collapse,
which Wall Street would hate,
or they pass the cost on to the consumer. And they clearly chose the latter.
Yeah, their outgoing CFO, Bob Fishman, was incredibly blunt about this dynamic on the call.
What did he say?
He basically stated that Pentair operates with a fundamental conviction that they have a right to recapture inflationary pressures through price increases.
A right to recapture, that's strong wording.
Very strong. If metal inflation persists, they will immediately review their pricing structures and force those costs right through the distribution channel.
But forcing price hikes onto the consumer requires a very specific market dynamic, right? You can't just hike the price of a discretionary luxury item without destroying demand.
Normally, no.
Like if a flat screen TV suddenly costs 30% more because of a microchip shortage, I just won't buy the TV. I'll keep my old one.
Right.
So why doesn't the pool consumer just walk away when Pentair hikes the price of a pump by 15%?
Because pool equipment occupies a very strange economic space.
Okay, how so?
A swimming pool is an entirely discretionary luxury asset to build. But once it is built, the equipment required to run it becomes non-discretionary repair spending.
Oh, it's a captive market.
It is the hostage dynamic.
The hostage dynamic. If my variable speed pool pump completely seizes up and dies in the middle of July, I don't have the luxury of waiting 12 months for copper prices to stabilize so I can get a better deal on a replacement.
Exactly. If the water stops moving, the pool turns into a toxic, algae-filled swamp within a week.
It becomes a massive liability.
Right. The consumer complains. They might yell at their local pool service technician about inflation, but ultimately, they hand over the credit card.
The pump must flow.
The pump must flow. Pentair possesses massive pricing power because the end user is highly incentivized to fix the problem immediately, regardless of the macroeconomic environment.
But there has to be a breaking point, right? Like a ceiling to how hard you can squeeze the consumer before they revolt.
Yes, and CEO John Stelk actually addressed this during the Q&A portion of the call. He admitted that they cannot blindly rely on inflationary price hikes forever.
Okay.
He specifically mentioned that Pentair needs to work cooperatively with their channel partners, the pool dealers and distributors, to ensure they are adding actual value to the pool pad rather than just demanding more money for legacy hardware.
Yeah, because if you just keep jacking up the price of a basic dumb mechanical pump, eventually the consumer is going to tell their pool guy to go buy a cheap imported knockoff instead.
Exactly. Stelk is acutely aware of the threat of commoditization. To justify a premium price tag in a tight economy, you have to offer a premium, highly differentiated experience.
And this is where their pivot to technology comes into play, isn't it? They spent a significant amount of time highlighting new product introductions, things that sound like they belong in a smart home rather than a utility closet.
Totally. They highlighted products like the IntelliCore Plus, their IntelliVibe lighting systems, and advanced app-driven automation arrays.
Smart pools.
Yeah, they are actively trying to turn the pool pad into an integrated smart ecosystem.
It's the Apple ecosystem strategy applied to industrial water flow.
That is a perfect analogy. Because if you buy the Pentair automated controller, you are highly incentivized to buy the Pentair variable speed pump, the Pentair intelligent heater, and the Pentair LED lighting system.
Because they all talk to each other seamlessly on your smartphone.
Exactly. When a consumer is locked into that ecosystem, a cheap overseas import pump suddenly looks incredibly unappealing because it breaks the automation loop.
It ruins the smart home vibe.
Right. And as Stelk noted, they do not see cheap imports threatening their technologically advanced products. They only see that threat at the lower commoditized end of the market.
Which, wait, perfectly looping back to our earlier point, is exactly the quad 4 revenue they have been strategically abandoning. That is a brilliant synthesis of the strategy. They are shedding the low-end, highly competitive junk, focusing the factories on high-tech smart systems, and using the hostage dynamic of the broken pool to push through price hikes when raw materials inflate.
That entirely explains the 11% growth in a flat market.
All right, now let's pivot to the segment that looks like a total disaster on paper. Water solutions.
Right, down 10%.
Revenue dropped 10% in the fourth quarter. Now, if I'm just skimming the headlines, a double-digit revenue contraction in a core business unit is a massive red flag. Why did Water Solutions take such a beating?
Well, the truth is it didn't take a beating.
It didn't.
No, and this is why reading the actual transcript of the earnings call rather than just the press release is absolutely mandatory for a serious investor.
Okay, lay it on me.
That 10% drop is almost entirely optical. It is driven by strategic corporate structuring and macroeconomic math, not a failure of their product line.
Okay, break down the corporate structuring piece first. Did they pull another Gulfstream, but in reverse?
Precisely. The Water Solutions segment includes an 11% negative impact from a strategic divestiture.
What did they sell?
Back in the second quarter of 2025, Pentair deliberately sold off their commercial services business.
But why would they sell an entire arm of their business? Didn't that commercial services group generate reliable revenue by maintaining commercial filtration systems?
It generated revenue, yes, but remember the 80-20 rule. Revenue is not the goal. Highly profitable, frictionless revenue is the goal.
Okay.
A commercial services business is incredibly labor-intensive. It requires managing fleets of trucks, routing technicians, dealing with localized labor markets, and handling thousands of small, bespoke service contracts.
Right, it's totally different from manufacturing.
It's essentially a massive, localized logistics operation grafted onto a global manufacturing company. Management looked at it and realized the margins were structurally lower than their core manufacturing business.
And the operational headache was immense, I imagine.
Massive, so they excised it. They sold it off to sharpen their portfolio focus.
So when we compare Q4 2025 to Q4 2024, the 2024 number includes millions of dollars from that commercial services business, and the 2025 number doesn't.
Exactly.
You are literally subtracting a huge chunk of revenue from the comparison, which mathematically forces the growth percentage to look deeply negative.
Right. Operationally, the company became leaner and more profitable, but on the top-line spreadsheet, it looks like a 10% contraction.
Okay, that makes sense. And there was a secondary factor dragging that number down even further, related to international currency markets, right? During the analyst Q&A, someone asked about a $10 million headwind specifically related to foreign exchange, or FX.
Yes. Foreign exchange impacts are a classic headache for global manufacturers. Let's walk through the mechanics of how this actually hurts the balance sheet.
Please do.
Pentair sells water filtration systems all over the world, including massive markets like China. When they sell a system in China, they get paid in local currency, the Chinese yuan.
Right, but Pentair is an American company. They report their earnings to Wall Street in US dollars.
Exactly. So at the end of the quarter, Pentair has to take that pile of Chinese yuan and mathematically convert it back into US dollars to put on their earnings report.
Okay.
CFO Bob Fishman explained that Pentair had a significant cash build in certain international countries, meaning they had large reserves of local currency sitting in foreign accounts.
And if the US dollar gets incredibly strong relative to those foreign currencies?
Then the math punishes you severely. Let's say a year ago, it took 7 yuan to equal 1 US dollar. But because of shifting global interest rates, the US dollar strengthens, and now it takes 7.5 yuan to equal $1.
The physical amount of water filtration systems Pentair sold in China didn't change, though.
No, the piled yuan is exactly the same size. But when they run the conversion math for the Q4 report, that piled yuan translates into millions of fewer US dollars.
Wow.
That's a negative FX impact. It is a paper loss driven by global currency fluctuations, not a loss of market share.
So between deliberately amputating the commercial services business and getting squeezed by the strength of the US dollar, that 10% drop is basically just an accounting ghost.
It is.
What is the actual organic state of the water solutions business underneath all that noise?
The organic demand for their core filtration and commercial ice products remains remarkably robust, particularly in North America.
Really?
Yeah. Management specifically highlighted their Everpure filtration brand and their Manitowoc Ice business. In fact, they noted that these brands just won Kitchen Innovation Awards at the National Restaurant Association show.
I mean, winning industry awards is great PR, but what actually drives the organic demand for commercial water filtration right now? It feels like an incredibly crowded, commoditized market. Like a filter is just a filter, right?
Not more. And this is where Pentair's technological moat becomes highly relevant. A filter is no longer just about removing sediment or, chlorine taste.
Okay, what is it about?
We are entering an era of intense regulatory and public health scrutiny regarding water quality. The specific catalyst driving high-end filtration demand right now is the massive public awareness around PFAS.
PFAS, the forever chemicals.
Exactly.
This is dominating environmental news cycles globally.
It is. Per-ant polyfluoroalkyl substances. These are synthetic chemicals used for decades in nonstick cookware, firefighting foam, water-resistant clothing.
They're everywhere.
Yes. The problem is they do not break down in the environment or in the human body, and they are now pervasive in municipal water supplies across the globe.
And the government is stepping in.
Big time. The EPA is aggressively rolling out strict, legally enforceable limits on PFAS in drinking water.
And I imagine removing forever chemicals from a municipal water line flowing into a commercial restaurant or residential home requires vastly more sophisticated technology than a standard charcoal Brita filter.
It requires advanced multi-stage carbon block and reverse osmosis membrane technology capable of trapping microscopic chemical bonds.
Right.
Pentair's Everpure systems are winning awards precisely because they are engineered to meet these incoming stringent EPA standards.
That shifts the narrative entirely. If you are a national restaurant chain or a hospital or a high-end coffee shop, you cannot afford the liability or the brand damage of serving water contaminated with forever chemicals.
You can't.
You are essentially forced to upgrade your entire filtration infrastructure to meet the new EPA baselines.
And that creates a massive long-term secular tailwind. Water quality and safety are rapidly shifting from a luxury upgrade to a highly regulated, non-negotiable mandate.
Wow.
If you hold the patents on the specific mechanical technology required to remove forever chemicals at scale, you possess an incredibly defensible economic moat.
So despite the optical 10% drop in Q4, the long-term mechanics of the water solutions segment are incredibly bullish.
Absolutely.
Okay, let's look at the third and final segment, flow. This segment encompasses their heavy-duty agricultural, industrial, and residential water movement pumps. Sales were up 9% to $394 million. And within that segment, the commercial and industrial subsectors both jumped a massive 12%. This looks like the cleanest, most straightforward win of the entire quarter.
It was an exceptionally strong execution by the Flow team. The headline revenue is great, but the profitability metric is what's staggering.
Let's hear it.
Return on sales for the Flow segment jumped 240 basis points to 22.8%.
A 2.4% margin expansion in a heavy industrial segment is huge. You are talking about moving massive steel pumps, not software. What drove that leap in profitability?
They executed the exact same three-part playbook we saw in the pool segment.
Okay, walk me through it.
First, aggressive price increases to offset inflation.
Check.
Second, bolt-on M&A. They acquired a company called Hydrostop, bolting on immediate high-margin revenue in the commercial space.
Okay.
And third, the internal 80-20 transformation efficiencies. They pruned the low-margin industrial orders and ran the factories strictly for high-yield throughput.
It is remarkably consistent. Across all three segments, the architecture of their success is identical. They refuse to eat inflation, they buy strategic market share, they dump the operational deadweight, and they optimize the factory floor.
Right.
But here's where the story takes a massive structural turn. Pentair is not just resting on this optimized three-segment structure.
No, they're not.
During the call, management outlined a massive strategic consolidation that is going to fundamentally alter how this company operates, starting in the first quarter of 2026.
This is perhaps the most critical takeaway for an investor trying to model Pentair's future earnings, because they are essentially tearing down the walls of their internal silos.
Break down the mechanics of this reorganization. What exactly are they smashing together, and why risk disrupting a machine that just produced record cash flow?
Okay, so starting in Q1 2026, Pentair is taking the residential flow business, the pumps that move water into your house, and physically merging it with the residential water solutions business, the filtration and softening systems that treat the water once it's inside. They are combining these two highly distinct product lines into a single unified segment that they're dubbing a $1 billion water quality management juggernaut, led by an executive named Jamin Wiggins.
But historically, why were they separated in the first place? A residential water pump and a residential water softener sit right next to each other in the utility room. Why treat them as entirely different businesses?
Because historically, they were sold through entirely different channels to entirely different types of tradespeople.
I thought.
Yeah. The residential flow business, the well pumps and sump pumps, was a rugged mechanical business sold through traditional plumbing distributors to well diggers and everyday plumbers.
Okay.
The water treatment business, on the other hand, was treated as a highly specialized, almost bespoke chemistry play. It was sold through specialty filtration dealers to high-end water treatment professionals.
So you literally had two different Pentair sales representatives operating out of two different divisions with two different supply chains, potentially driving past each other to service the exact same geographic territory.
Exactly. It was wildly inefficient. But management realized that the end market has fundamentally shifted. The everyday plumber is no longer just installing pipes and pumps.
Right, because water quality has become a mainstream concern. The average homeowner who calls a plumber to fix a well pump is now asking that same plumber about PFAS, hard water, and whole home filtration.
Precisely. The demand for advanced water treatment is rapidly migrating into the traditional North American plumbing channel.
So the plumber is becoming the primary point of sale for the entire utility room.
Exactly. By merging these two business units under one leadership umbrella, Pentair can radically streamline their go-to-market strategy.
I see the synergy now. Instead of the plumbing distributor having to navigate two different Pentair corporate divisions, they deal with one unified sales force.
Right.
The Pentair rep walks into the distributor and says, "Hey, you already buy 10,000 of our well pumps every year. Let's bundle that with our advanced reverse osmosis systems, and we'll train your plumbers on how to cross-sell the entire package to the homeowner."
It is massive cross-selling leverage at scale. But the synergies go far deeper than just the sales force. This combination touches the physical infrastructure of the company.
How much infrastructure?
These two merged residential units represent roughly 25% of all Pentair manufacturing facilities globally.
A quarter of their factory footprint is getting reorganized.
Yes.
That is a massive logistical undertaking. Merging ERP systems, combining warehouse spaces, streamlining logistics.
It is a heavy lift in the short term, but the long-term payoff is exactly what drives that margin expansion we keep talking about. By merging 25% of their factories, they expect to realize significant structural cost savings in manufacturing overhead, regional logistics, and general and administrative, or G&A, expenses over the next several years.
Like closing duplicate facilities.
Exactly. If you have two half-empty warehouses across town from each other, you close one, consolidate the inventory, and immediately drop the rent and staffing costs directly to the bottom line.
So when retail investors look at the Q1 2026 earnings report in a few months, the architecture of the spreadsheet is going to look completely different.
Oh, completely.
The flow segment will essentially become purely commercial and industrial flow, and the water solutions segment will hold the entire residential portfolio, both pumps and filtration, alongside their commercial ice and filtration arms.
That is correct. It is a brilliant strategic realignment designed to capture every single dollar spent inside a residential utility room while simultaneously gutting redundant factory overhead.
Okay, we have thoroughly diagnosed the underlying machine. We've looked at the 80-20 pruning, the pricing power masking flat volume, the defensive M&A strategy, the divestitures, the FX headwinds, the forever chemical macro trends, and this massive internal reorganization.
Right, we've covered the foundation.
We know exactly why 2025 was a record-breaking year. But the stock market does not care about 2025 anymore. The market is a forward-looking voting machine. Because pricing hikes carried so much of the weight in 2025, and because they are about to disrupt a quarter of their factory floor with this merger, the absolute critical question is whether Pentair can maintain this momentum in 2026.
Which brings us directly to management's guidance for 2026. And this is where we have to heavily scrutinize their assumptions.
Why is that?
Because they are painting a very specific and frankly very defensive picture of the next 12 months.
Okay, let's lay out the forecast data they provided to Wall Street. For the full year 2026, Pentair expects adjusted EPS to land between $5.25 and $5.40. At the midpoint, that is an 8% bottom line increase over 2025's record numbers.
Solid.
However, they only expect total top-line sales to grow by 3% to 4%.
Right.
And they're targeting adjusted operating income to rise 5% to 8%, aiming for a 26% overall margin, which implies another 100 basis points of margin expansion.
So the math here tells a very clear story of operating leverage.
Oh.
They are forecasting their bottom line profits to grow twice as fast as their top line sales.
Yeah.
8% EPS growth generated from a mere 4% revenue growth.
Which implies that they expect their internal cost cutting, their factory consolidations, and their pricing strategies to be incredibly effective at capturing profit from every new dollar that walks through the door.
Yes. But to understand the true nature of this guidance, we have to look past the final numbers and examine the foundational assumptions they built the model on.
Okay.
During the call, CEO John Stelk made a statement about the macro environment that completely dictates how investors should view this forecast.
You were talking about the pool volume assumption.
Yes.
Stelk flat out stated that their guidance actively assumes zero residential pool market recovery in 2026.
Zero.
They are modeling for organic pool volume to be totally flat year over year. Let's pause and analyze that. Pool is one of their most profitable segments. It just posted 11% growth in Q4 due to pricing and acquisitions.
Right.
To build your entire 2026 financial model on the assumption that organic consumer demand will not recover a single inch for 12 months is an incredibly conservative defensive posture.
It is what Wall Street calls a heavily sandbagged guide.
Sandbagged.
Management is intentionally setting the bar as low as realistically possible.
So, to use a mechanical metaphor, they are putting the bicycle in the highest possible gear before they even start pedaling. It makes the initial start incredibly difficult, but they are assuming the absolute worst-case scenario for friction.
That is a highly accurate way to look at it. And during the analyst Q&A, Julian Mitchell from Barclays pressed them on the specific cadence of this friction.
Oh, interesting.
He pointed out that their flat volume assumption implies a very strange, almost painful quarter-by-quarter progression for 2026.
Wait, how does the math break down quarter by quarter? Because they can't just be flat every single month, can they?
They can't, because of the concept of comparables or comps. Remember, Pentair pushed massive, aggressive price increases through the channel in the first half of 2025 to combat inflation.
Right, the 11% spike we dissected earlier.
Exactly. When you have a massive spike in Q1 of 2025, the year-over-year comparison for Q1 of 2026 becomes incredibly difficult to beat. Wall Street calls this a tough comp. Because of those tough comps, Pentair actually expects their volume to be slightly negative in the first half of 2026.
Negative volume.
They are assuming a bumpy, sluggish start to the year, and then modeling a volume recovery in the back half of the year as the comparables get easier, resulting in a net flat year overall.
But if they expect negative volume in the first half of the year, how on earth are they projecting 8% EPS growth? You can't just shrink your way to record profits indefinitely.
You can't, which is why Stelk explicitly noted that they wanted to put the potential for an actual macroeconomic pool market recovery into the upside category.
Oh, so it's a bonus if it happens.
Exactly.
Yeah.
They refuse to bake a consumer recovery into their base expectations because if the consumer remains stretched by high interest rates and inflation, Pentair would miss their earnings targets and the stock would plummet.
So they are padding the downside risk. They are telling Wall Street, we can hit 8% profit growth even if the housing market stays completely frozen. And that padding is necessary because the macro environment isn't just stagnant, it is actively hostile. We have to talk about the tariffs.
The word tariffs is enough to send a cold sweat down the spine of any global supply chain manager.
Seriously, tariffs are essentially a massive arbitrary tax slapped onto the cost of raw materials and finished goods crossing international borders.
Right.
Let's look at the hard data they provided on slide 18 of their earnings presentation. In 2025, Pentair had to absorb roughly $70 million in tariff impacts.
A huge hit.
For 2026, they are modeling an incremental $30 million hit.
And that word incremental is key. An incremental $30 million means that $30 million is in addition to the baseline.
So the total annual tariff burden dragging on their balance sheet is now roughly $100 million.
That is $100 million of pure friction that produces absolutely no value for the end consumer.
And the timing of this new hit is brutal. Management noted that this incremental $30 million is going to land primarily in the first quarter of 2026.
Which perfectly explains why they are projecting such a bumpy start to the year.
Let's synthesize this Q1 reality. If I am the CEO, I am staring down a first quarter where I am assuming negative organic volume growth due to tough comparables. And the moment the quarter starts, the government hands me a $30 million tax bill on my supply chain.
It looks bleak.
Mechanically, the math should result in a disastrous quarter. Margins should compress and earnings should contract. Yet they are guiding for 100 basis points of margin expansion for the year.
Yeah.
I need you to explain the exact mechanical engine that allows a company to absorb a $30 million gut punch while simultaneously expanding profitability.
That engine is what Pentair officially calls their transformation engine. We touched on the philosophical side of this earlier with the 80-20 rule, but the transformation engine is the physical dollar and cents manifestation of that philosophy on the balance sheet.
They attach a very specific, aggressive dollar amount to this engine during the call, right?
Yes. They are explicitly targeting $70 million in net transformation savings for the full year 2026.
I want to stop and highlight a single word in that projection. The phrase net of investments is crucial here. Walk us through the difference between gross savings and net savings in a corporate turnaround.
It is the difference between surviving and dominating. When a company finds gross savings, say they close a factory, renegotiate a shipping contract, and fire a layer of middle management, they might generate $100 million in gross cash savings.
Okay.
A struggling company will take that entire $100 million and drop it straight to the bottom line just to keep the lights on and appease Wall Street.
They use the savings as a life raft.
Exactly. But Pentair is not struggling. Pentair is generating $70 million in net savings.
Meaning?
That means they're finding vastly more than $70 million in gross operational efficiencies across their supply chain and factory floor. But instead of just banking it all, they're taking a massive chunk of those gross savings and aggressively reinvesting it back into the business to fund future growth.
They are funding their own evolution out of the fat they are trimming from the legacy business. What specifically are they reinvesting that cash into?
Management specifically highlighted heavy reinvestments into digital initiatives, the integration of artificial intelligence into their smart products, and advanced new product innovation.
Right, the smart pools and PFAS filters.
Yes. They have a new head of strategy, Adrian Chu, who is directing this capital toward building the technological moat we discussed earlier. Once all of those R&D and digital investments are fully paid for, the remaining net cash that drops to the bottom line to offset the tariffs and drive EPS growth is $70 million.
That is a staggering level of self-funded structural evolution. But during the Q&A, an analyst named Jeff Hammond from KeyBank asked a really probing, almost skeptical question about the actual mechanics of these savings.
Oh, that was a great question.
He noted that in previous quarters, Pentair had outlined specific buckets for where these savings were supposed to come from, and it looked like they had fallen behind on their targets for factory floor efficiency.
It was a highly perceptive question by the analyst because it attacks the core assumption of the 80-20 rule. The theory is that if you prune the bad customers, your factory floor becomes hyper-efficient. But in reality, it is incredibly difficult to get maximum operational leverage out of a factory line if the overall market volume is depressed.
Right. To go back to the bicycle analogy, you can put the bike in high gear and oil the chain perfectly, but if you are riding through thick mud, a depressed housing market, you still aren't going to break any speed records.
Exactly.
A factory needs massive sustained volume flowing through the machines to realize peak efficiency margins.
And Stelk gave a very candid, transparent answer to that. He admitted that Pentair did indeed underperform on the volume leverage aspect of their operational efficiencies. Because the pool market was flat, the factories simply didn't have enough raw throughput to hit their maximum margin targets.
So if the factory floor didn't generate the bulk of the $70 million, where did the money actually come from?
Stelk explained that while they underperformed on factory volume leverage, they massively overperformed in two other crucial areas: strategic sourcing and pricing execution.
Let's break down strategic sourcing. What does that actually mean mechanically?
It means their supply chain team executed brilliantly. Despite the chaos in the global metals market and the incoming tariffs, Pentair's procurement team was able to renegotiate contracts, find alternative global suppliers, and consolidate their purchasing power to buy raw materials vastly cheaper than their internal models projected.
So they bought the lemons significantly cheaper than expected.
Exactly.
And combined with their overperformance in pricing execution, meaning they successfully hiked prices on the consumer without destroying demand, they generated enough cash to cover up the fact that the factories were running below peak efficiency.
Precisely. And this dynamic creates a massive coiled spring for the company's future earnings power.
The coiled spring, I love that. Explain the physics of that setup for the investor.
Stelk pointed out that while the factory floor isn't generating peak margins today due to low volume, the structural work has already been completed.
They did the hard part.
They have spent the last 2 years reorganizing the lines, closing the redundant facilities, and eliminating the quad 4 friction. The machine has been perfectly tuned for a low volume environment.
So what happens when the macro environment finally thaws? What happens when interest rates eventually drop, the housing market unlocks, and consumers start building pools again?
When that organic market volume eventually returns and begins surging through these newly streamlined factories, the operational leverage will be explosive.
Oh, wow.
Pentair will not need to build new factories or hire massive amounts of overhead to handle the surge. The throughput will hit the bottom line with almost zero friction. The margin expansion we are seeing today is just a fraction of what this machine is capable of generating in a healthy macro environment.
Okay, let's pull all of these massive threads together into a cohesive thesis for the listener. We have diagnosed a company with 15 consecutive quarters of margin expansion. They are generating record free cash flow. They are in the middle of a massive structural reorganization in their residential segments to capture the entire plumbing channel.
Yep.
They have issued incredibly defensive, sandbagged 2026 guidance that assumes a totally flat pool market. And they possess a self-funded transformation engine designed to spit out $70 million in net savings to offset $30 million in new tariffs.
It's quite the setup.
When you synthesize the macro threats and the internal mechanics, what is the ultimate verdict for the retail investor listening right now? Are we looking at a bullish or a bearish setup?
I take a decidedly bullish stance on Pentair for the long-term dividend-focused investor. The structural mechanics of the company are simply too robust to ignore.
Okay.
However, that bullish long-term thesis comes with a very clear, very bright short-term caution flag that investors need to navigate.
Let's lay out the foundation of the bull case first and then hit me with the caution flag. What is the ultimate metric that proves this machine is built to last?
The bull case rests entirely on their fundamental financial architecture, specifically their balance sheet and their capital efficiency. Pentair operates with a fortress balance sheet. Their leverage ratio is incredibly healthy at just 1.4 times.
Let's translate that leverage ratio. That essentially means their total debt levels are very low relative to the massive amount of free cash flow their operations generate every year.
Right.
They are not overextended. If the credit markets freeze up tomorrow, Pentair is not going to struggle to make debt payments.
Exactly. They have massive financial flexibility. But the most compelling metric for the long-term investor is their return on invested capital, or ROIC.
ROIC. This sounds like an obscure, deep-in-the-weeds accounting metric that retail investors usually gloss over. Why should I care about ROIC more than I care about top-line revenue growth?
Because ROIC is arguably the single most important metric for evaluating the true competence of a management team. Revenue growth can be bought with cheap debt. Margin expansion can be faked in the short term by starving the company of R&D. But return on invested capital measures the absolute truth. How efficiently is management using the capital it raises, both debt and shareholder equity, to generate cash returns?
So it's a measure of their capital compounding engine.
Yes. In 2024, Pentair's ROIC was 15.5%. In 2025, it expanded to a phenomenal 16.7%.
Let's apply that to the real world. A 16.7% ROIC means that every single time Pentair takes a dollar and invests it back into their business.
Whether they're using that dollar to build a new automated assembly line, acquire a strategic bolt-on company like Gulfstream, or fund Adrian Chu's AI research and development.
They are generating nearly 17 cents of pure recurring profit on that invested dollar every single year.
Precisely. That is the hallmark of a highly efficient wealth compounding machine. Most companies destroy capital when they try to grow. Pentair is generating massive premiums on their investments. When you combine a high teens ROIC with a fortress balance sheet, a dominant market position in water technology, and a 50-year track record of consistently increasing the dividend payout, you have the exact profile of a cornerstone stock for a long-term set-and-forget portfolio.
That is an incredibly compelling long-term thesis. So what is the short-term caution flag? Where is the pothole that could damage the stock in the immediate future?
The caution flag is entirely centered on the psychological reaction of Wall Street traders to the first quarter of 2026. As we discussed, Q1 is going to absorb the absolute brunt of that $30 million incremental tariff hit. Q1 is also, historically, their weakest quarter for sales due to normal seasonal weather patterns.
Right. People in the Midwest are not generally digging new pools or upgrading water softeners in the frozen ground of February.
Exactly. Furthermore, because of the massive price hikes they pushed through in Q1 of last year, management is explicitly projecting negative organic volume growth in the first half of 2026 due to those tough comparables.
Let's visualize this. You are a retail investor. It's mid-April. You open your brokerage app, and the Pentair Q1 earnings headline hits the wire. The raw, unadjusted numbers might look quite ugly.
They might.
Margins might look temporarily squeezed by the sudden tariff impact, and top-line revenue growth might be sluggish or even slightly negative.
And that is the moment of maximum risk. The risk is that the market's algorithmic trading programs and short-term speculators overreact to a bumpy Q1 print, completely ignoring the fact that management explicitly forecasted this exact cadence months in advance.
They warned us.
Right. But the market might punish the stock anyway, forgetting that the transformation engine savings and the back half volume recovery are mathematically designed to kick into high gear in Q3 and Q4.
So the caution flag is really a warning about market volatility. But if you already hold this stock in a long-term portfolio, management's aggressively sandbagged guidance is actually a very comfortable place to sit.
Absolutely.
They have set Wall Street's expectations so incredibly low regarding the housing market and consumer demand that any positive macroeconomic surprise represents pure, unadulterated upside.
Yes. If the Federal Reserve cuts interest rates faster than expected, thawing the housing market and spurring a sudden wave of new pool construction, that organic volume is not currently priced into Pentair's internal forecast.
It would be pure leverage flowing directly to the bottom line of their newly optimized factory floors.
Exactly.
And that dynamic leads us perfectly into our final, most provocative thought for you to chew on today. We have talked extensively about how much cash this machine generates, but we haven't talked about the ultimate lever management has at their disposal for deploying that cash.
Oh, this is the best part.
During the earnings call, Nick Brizzies, who is stepping in as the new CFO, casually dropped a massive piece of news that barely made the headlines. He noted that the board of directors just authorized a brand new $1 billion share repurchase program.
We need to pause and recognize the scale of that authorization. $1 billion represents roughly 10% of Pentair's entire market capitalization.
10% of the company. Let's connect the strategic dots here. We just established that Q1 2026 is going to be bumpy due to tariffs and tough comparables.
Right.
We established that short-term traders might spook and sell off the stock in April, creating a temporary dip in the share price. If you are John Stelk and Nick Brizzies, sitting on a mountain of free cash flow and a brand new $1 billion buyback authorization, could you use that temporary tariff-driven weakness in the stock price to aggressively deploy that capital and buy back your own shares at a massive discount?
It would be the textbook masterclass definition of exceptional capital allocation. If the management team truly believes their transformation engine is working, and they know the back half of the year is going to be incredibly strong, but the market temporarily discounts the stock because of a noisy Q1, they have the firepower to step in and buy back 10% of the company from panicking short-term traders.
And let's explain the physical mechanics of why a share buyback is so powerful for the long-term retail investor. Imagine the company's total profits are a pizza.
Okay, a pizza.
Every outstanding share of stock is a slice of that pizza.
Right.
If Pentair uses that $1 billion to buy back 10% of their outstanding shares and permanently retires them, they essentially remove slices from the table.
Exactly. And by removing those slices, the remaining slices, the shares held by the long-term investors, automatically represent a proportionally larger claim on the total cheese.
Right.
In financial terms, you dramatically reduce the denominator in the earnings per share calculation.
So even if the macroeconomic environment remains completely frozen and Pentair's total net income stays perfectly flat, their earnings per share skyrockets because those exact same profits are now divided among 10% fewer shares.
It is a mathematical force multiplier. By aggressively shrinking the share count during a temporary period of weakness, management can artificially supercharge their EPS right before a potential 2027 macroeconomic recovery.
Which is huge.
And when that organic market volume finally does return and the immense operational leverage from the factory floor kicks in, the earnings explosion on those reduced shares will be astronomical.
It is a brilliant, multi-layered defensive and offensive strategy. So as you, the listener, evaluate Pentair over the next 12 months, do not just look at the surface level headline of whether the pool pump is running today. Look deeper into the mechanics.
Always look deeper.
Look at how this management team is relentlessly optimizing the internal architecture of the machine for the exact moment the macroeconomic water starts flowing again. Are they ruthlessly executing the 80-20 pruning? Are they successfully passing the new tariff costs through the channel without cratering consumer demand?
And most importantly, are they aggressively deploying that billion-dollar buyback into the Q1 weakness?
Exactly. These are the mechanical dynamics you need to watch closely, because in the incredibly murky, unpredictable waters of the current global economy, a management team that possesses paranoid capital discipline, a technological moat, and knows exactly where they are steering the ship is the most valuable asset you can possibly own.